Please pardon the following interruption for a public service announcement.
Welcome to the Investing in Intelligence show, where we talk about artificial intelligence companies, stocks, and trading. I'm James here with my co-host Kai, and today we'll be talking about Cadence Design Systems, CDNS. I want to remind you that the opinions expressed on the show are just that, opinions. They should not be taken as specific advice to invest in a particular way. So Kai, I wanted to start off by showing you something cool. In my opinion, one of the most significant inventions that mankind has ever seen, maybe the most significant invention that mankind has ever seen. So a lot of things have been leading up to this: electricity, then came telecommunications and phones, then came the internet, then came AI, and now we officially have this. Watch and be amazed.
Find the 5 most popular videos on Matt Wolf's YouTube channel and add the dates and title of each of them to a spreadsheet. Press enter and watch as the tool opens Firefox for me, navigates to YouTube for me, searches out Matt Wolf, clicks into my channel for me. It clicks on the videos tab, sorts it by most popular, opens up a spreadsheet for me, and then watch as one by one it adds each of the titles of my most popular videos and pulls in the time since it was released. It just scraped it straight from my YouTube channel and is creating the spreadsheet hands-free. It just went through that whole process and just did each of the steps until I have the spreadsheet that you see on the screen right now. I'm talking as it's doing it. I'm not doing anything.
All right, I'm going to go ahead and stop it there. So when you hear people talk about how AI is going to replace 70% of jobs, this is the kind of thing they're talking about. They're not saying that ChatGPT, asking a question to ChatGPT or Claude, that's going to replace 70%. What we're talking about is agentic AI. And all of a sudden, in the second half of this year, we've really started to see the early underpinnings of agentic AI. And I just showed a video of Matt Wolf, probably the most famous AI content creator, using Claude's new agent. And essentially, you can tell it what you want it to do, and it will do that on your computer with some limitations. But those limitations will shrink and shrink with time. So just wanted to show that to you, Kai. Probably something that you hadn't seen yet. Am I correct?
Yeah, no, I haven't seen that yet.
So yeah, I wanted to show that to you. This is the kind of a thing that's going to really lead to massive, drastic change in our society. In my opinion, this is probably the biggest invention that I've ever seen in my life. And as you know, I've seen cell phones. I've seen the internet invented in my life. I had the first MacBook Pro. I had the first iPhone. But in my opinion, this is actually a replacement for a human being. And MacBook Pros and cell phones weren't a replacement for a human being. So this is probably the most influential, most significant invention that I've seen in my life. And no one's even talking about it. No one even mentioned that now we have an agent from Claude that can pretty much go and do what you ask it to on a computer.
Yeah, I mean, pretty cool. Still yet to be seen. I mean, I do not envision, I heard Elon Musk talking about 2-to-1 Optimus robots for every human being in the world. Man, I admire the guy. I mean, he shoots for the stars and makes it to the moon. But in this instance, I don't know. It's going to be difficult to visualize that. I don't think any of us can necessarily conceptually visualize the future. It's a lot of it has been, burned in our brain from science fiction movies, etc. But one of the things that we talk about on this podcast is just AI and how it affects our lives and the companies that may benefit from that. But pretty cool. It's an exciting time to live, wouldn't you think? It's very exciting.
I think so, but I think the way, so if you want to be a technologist or a futurist, you don't want to think about it as in what do you see in the movies. Think about it as in what has actually happened up to this point. So you would have thought someone was crazy 30 years ago if they had said each person will have 2 computers. And what is a computer 30 years ago? Like, why would anybody have a computer 30 years ago? And now you have an iPhone, which is a computer. You have a laptop, which is a computer. And you might even have something like an iPad, which is a computer. Our TVs have computers in them. Our cars have computers in them. So each person now probably has 4 or 5 computers attached to them and their identity. Not to mention, I have personally 2 cell phones. So I think the 2 robots to 1 person thing, it sounds like something sci-fi, but in reality, we're headed that way.
There's a lot of jobs that just stop without the functioning of computers, and people just forget how to function without them a lot of times. And it is a problem too, We've seen this year in multiple different factions, including the airline industry. We saw this in the medical healthcare field. It's a big problem. I mean, and those two are an example. I mean, can you imagine, James, you're going in to have surgery or going in to do certain things, and just because computers go down, the whole system of scheduling and charting and being able to function as a medical community is just gone. It just delays things. It shuts things down completely. And we saw this with the airline industry, just in regards to scheduling, etc. So we live in a different time period. I did not envision a time where you would just have a computer at your fingertips in your pocket as you walked around everywhere quickly within a period of 20 years. So my point is, with that all being said, is it's yet to be seen how AI is going to play out. There's going to be some things that are going to come true in regards to certain things like self-driving cars, self-driving vehicles. That is happening. That is going to be a recent future for us. But there's going to be a lot of unforeseen things too. Would you agree with that? I mean, just in ways that affects our life.
I mean, ChatGPT has already integrated itself so deeply into daily life. I was listening to a Spanish podcast earlier today that I like to listen to. Last time I listened to it was probably a few months ago. They used ChatGPT 5 times on this Spanish podcast that it's like 4 or 5 guys in Mexico that make it. I mean, it's deeply penetrated into Mexico. I would say that at this point in time, I'm starting to realize why I started this podcast. And the reason why I wanted to start this podcast, I don't know what your reasons were, but my reason was because I looked into the future and I saw a point in time where assets are worth more than jobs. So I saw a point in time in the not so distant future where whatever work you do can be done by a combination of AI and robotics, and thus you don't really have that work anymore. So the only thing you have that's really valuable is either your house that you own, your car, or let's say your cyber cab that you own, or, and this is why I really focused on this, your stocks that you own. And in my opinion, what are the stocks that are least threatened by AI and robotics? AI and robotic stocks. So I don't want to get too dystopic, but essentially I looked into the future and I said, hey, work is going to go away to a certain degree. Assets will be more valuable when people don't need to work as much.
Yeah, I mean, what we've seen is the stock market being dragged along by build out of AI and build out of cloud networking. Well, that's the true driver of what's going on. And a lot of people look at things and say there's just a huge disconnect in regards to how they think about the economy, the way the economy just looks to them just in general. We're seeing a lot of companies laying off employees, and so we keep hearing no landing, soft landing. I think we've been in a very soft recession or a recession for a long time, which has been masked by the build out phase of AI and cloud networking. So that's my particular opinion. I also think that stimulus money eventually, the effects of that we're going to see. So there's a lot of unknowns in the future, but a lot of unknowns in regards to how AI is actually going to affect our lives, and not just our in and out daily life, like cooking, cleaning, doing the yard work, but our particular jobs, in which jobs we sort of have to adapt and basically come up with a plan B or a plan C. You've talked about multiple times. I'm sure there's going to be a day, James, where you replace me on this podcast with an AI human being. Now, it won't be as, I would say, aesthetically pleasing. The robot you sent me this week, I don't know if I'm sure you're going to replace me with an AI sometime in the near future. So I've already come up with a plan C there. But yeah, let's talk about companies. And we talked about Amazon last week. So I briefly wanted to address that. Amazon earnings, including AWS, blowing out their earnings. I mean, Google Cloud Networking and AWS were, to me, the story of this week.
Yeah, I did catch Amazon's earnings. You know, we timed that pretty well right before Amazon probably had the best big tech earnings report of earnings season. We covered Amazon and we were both bullish on it. We've had a few stocks where we kind of parted ways on our take, but Amazon, we were both bullish and we were both right. It was a good buy right before earnings. Now, I wanted to just talk about a couple other stocks today. And by the way, there's a lot of stocks we haven't talked about yet, and I really want to start hitting these, back to back. Hopefully, each week we can get on and do one. But some of these stocks were missing, and if you look at their year to date gains, they've got 40%, 50%, 60% gains. Reddit is one I've mentioned. I wish we had talked about. Another one is Cadence Design Systems. It looks like a bearish to bullish reversal to me. So it looks like Cadence was kind of sold down or at least drastically underperformed for most of the year. And all of a sudden they've blown out earnings and they are starting to move up. So I can get into a bit more about my take on Cadence and kind of their work and why I see it as a potentially good AI play. But I will just start off by saying there are some who believe that there is no moat in software. So some believe that a company like Adobe, for example, which is strictly a software play, has no moat around their business and essentially cannot defend their business from new companies that try to disrupt them with their own software. So I will say, JFrog was a software pick that we didn't do so well on. Cadence Design is another software, but it's not. It's more of an enterprise software than it is public software.
Yeah. So I will say, I don't know if I agree with your comment on the whole year. Basically, chip stocks have been damaged, essentially the whole sector. So I don't know if it speaks to as much as Synopsys as a company as it does just in general chip stocks in regards to some of the guidance language that has been used in that sector. So we saw a pretty good run from chip stocks. For example, a company like ASML, Taiwan Semi at the beginning of the year. However, once we hit sort of June, July, the whole sector as a whole has been damaged, software somewhat included. JFrog, you mentioned JFrog. JFrog is actually a great company, however, had been damaged a little bit. I actually don't mind their numbers. I'm not a significant holder of JFrog. I have a small position in JFrog. But to me, I'm not a seller of JFrog. Currently, I'm a holder. But Synopsys and Cadence Design Systems, I think that's more of their story, James, than just, they've been just down the whole year, especially with Cadence Design Systems.
Yeah, my new take on software is if you're going to go software, you better go big. So going big in like enterprise software, B2B software for companies, I would say ServiceNow is a good one. We've liked ServiceNow and it's actually performed pretty well despite the middle of the year software downturn. Now, Cadence Design and Synopsys, they are electronic design automation softwares. So they help companies automate the chip design process. Before I go any further, let me say NVIDIA has made some mentions of using AI to actually design their own chips. So I do have a bit of concern for disruption to the sector in the future. That being said, Cadence has kind of put those concerns to bed for a bit because they just had a great earnings report and their stock was way up. I want to say 17% in the day or two after earnings. So they had a great earnings report. It looks like they're doing really well with the AI build out, and their revenue from system design and analysis was up 47% year over year. When you're looking at revenue for any segment in a business up 47% year over year, you see something is starting to move and shake there.
What's another one you like about Cadence Design in general and their main source of revenue? Is it this, what I'm hearing is just the automation design process of these chips, and that's how they make the main source of the revenue? Or what else? What's something else you like about the company regarding their financials?
Well, so they used to just focus on the software to help the software to help companies make chips, but now they're kind of designing chips themselves. They said, hey, look, this software we made is really good for designing chips. Let's design some chips ourselves. And in doing that, they also have intellectual property that they can sell licenses to. So they actually have a pretty well diversified business. If you listen to their earnings call, they go through and it's like 10% in this, 10% in this, 10% in this. And it's not like one of those companies where, 85%, not to mention ASML, but like 85% of them, 85% of their business is just, selling one or two machines. And maybe a huge percentage of that is selling to China. So I feel like they're not at risk as much as some of these other AI adjacent businesses. But it's important to understand the difference between Synopsys and Cadence Design. So Cadence Design has long been the leader in software for designing analog chips. And Synopsys has long been the leader in design for digital chips, but Cadence has moved into digital chip design and they're doing a lot better in that. So we can say pretty clearly that Cadence and Synopsys pretty much on the market. There is one other small player, I believe it is a segment of Siemens, and they're a smaller player. So Cadence and Synopsys pretty much on this market. So if you wanted to have good exposure to the market, you could buy a little of both. You don't necessarily have to go all in on Cadence, but Cadence is the one that just blew out earnings.
Yeah. So, and then another question I'd have is, so what do they do better than Synopsys? And the reason I want to ask you that question first, and then I'm going to follow up with a different follow-up question in regards to critique, and trying to you to convince me to be a buyer of CDNS of Cadence Design right now.
Well, so they do own 80% of the market in analog chips. So that's kind of a market that Synopsys doesn't have as much in. So they pretty much have a monopoly in the design of analog chips. We know that analog chips are more basic chips, like let's say a lot of the chips in your car are analog chips. Chip in a microwave is an analog chip. If you have an electric toothbrush, that's probably an analog chip. So more basic chips, they have 80% of that market. That's almost a monopoly. And what I would say is they've been an active acquirer. So they're acquiring other companies. They're trying to return 50% of cash flow to investors in the form of stock buybacks. Their margins are around 40%. So 30 to 40% for their margins, whether we're talking about GAAP or non-GAAP. So they just, in the end, what it comes down to me is the year over year revenue growth. And they're looking at 14% year over year revenue growth. So when I see mid-teens, upper teens year over year revenue growth, that's a company I'm interested in owning. Because we know that, in the end, when a company is finished growing, you're more looking at cash flow to see if that company is a good value and then how they return that cash flow through buybacks, dividends, whatever. But early on, you're really looking for revenue growth. So for me, this company has the revenue growth figure that I'm looking for. And so it's something that I want to own.
Yeah. So just for, I always say this, but a couple basics just out there. I really like the website Macro Trends. It gives you a good picture. This isn't a new company. You can actually look at a company picture for Cadence Design over a 10-year period. And what James is alluding to, is talking to, is you can get on Macro Trends, you can hit CDNS, and you can hit revenue. And it has an excellent chart for revenue growth over the last 10 years and quarterly revenue growth. It's just consistently going like this, as well as EPS. Their profit margins are excellent. The financials of this company look really good. Not only does it look good in the last 2 or 3 quarters, it looks good over a period of 10 years. So one of the first things I do is I love to check basically past history, past performance, or past history and past performance is one of the best predictors, in my opinion, of the next year's performance. And so that's step one. Step two is then I like to ask myself, is this company going to be around and utilized, and what product are they selling that people are going to use or other companies are going to use in 5 years? Okay, I like 5 years. I don't like 10 years for me. That's just 5, because especially with design companies, something like CDNS does with the competitors it has, I don't want to look out 10 years, but for me, 5. I think that's a sweet spot. Those are the 2 questions I ask myself. However, my biggest critique of CDNS, so I am currently a holder of CDNS. I'm not a buyer. And the reason is their PDE. I think they're overvalued, number one. Number two, they've already hit their price target for me. Now, I like the technical analysis. However, justify to me a PE of 50.
Well, I can justify it by, first of all, admitting a mistake. A moment ago, I talked about their year over year revenue growth at 14%, but it's actually not 14%, it's 19%. So their CAGR, their expected annual growth rate for the coming 10 years is 14% per year. But from last year to this year, their revenue grew at 19%. So there's your justification. 19% revenue growth year over year is essentially and high margins.
Then justify it. Just justify that. And so you mentioned Synopsys as a competitor. Synopsys PE is 39, and CDNS's PE is 46. So if you're trying to buy a better value in a particular company, why not buy Synopsys and not CDNS?
Well, so what are you seeing as the PE ratio for Cadence Design right now?
46. That's past. I'm looking at the 12-year PE. TTM.
Yeah. So I think this earnings report that we just had might change the numbers a little bit. So what I like to do, I like to look at a forward PE, and then you kind of have to give it a day or two for it to shake out.
Just doing, let's just say for the year, high side, it's 6, right? EPS for the year turns out to be 6. 6 times 50 is 300. So if you give them a PE of around 50, they're already at 300. I just think for me, they've already hit their price target. And so that's why I think they're trading where they are. Now, let me say that I am a holder of CDNS. I'm not a buyer currently. However, if you may be looking out 5 years, this is potentially a company that you'd want to have in your portfolio. I'm just saying that my particular style of trading sometimes is buy a company at a lower evaluation with a price target and some room to grow. For example, you and I have debated Amazon multiple times, and I thought Amazon at $160 a share was a steal. A steal when my price target from Amazon was anywhere between 220 to 250. So right now Amazon's trading at 200. So if I'm looking at buying CDNS versus Amazon, I'm buying Amazon right now because I think Amazon has another $20 to $50 a share to go. I think CDNS a little bit overvalued. I'm not saying it greatly overvalued, but a little bit overvalued based on the current PE.
Okay. So a few things there. So first of all, Amazon is a $2 billion market cap company, and I meant to say 2 trillion. Amazon is a two. Wait, am I saying this? I'm saying this wrong.
600 billion of revenue. 600 billion of revenue for the year. 600 billion of revenue. We talked about that before, and AWS growth is substantial.
So Amazon is a 2 trillion. I'm getting confused with my billions and trillions today. Amazon is a $2 trillion market cap company, whereas Cadence Design is a $77 billion market cap company. So just drastic difference in the sizes of these companies. I will say in general, it's easier for a $77 billion market cap company to grow than it is for a $2 trillion market cap company to grow. But let me just get back to a few things you said. So we have consistently made a mistake on the issue of PDE ratios. So on this show, we have repeatedly said, hey, this company has a PE ratio that's on the high end right now. We're not going to buy it right now because of that. So if you listen to any show on NBC, you're going to learn very, very quickly that valuations are not a timing tool. So they say this almost every single day on CNBC. Valuation is not a market timing tool. It's not a timing tool for a specific stock or for the market as a whole. So you'll hear them say on CNBC, oh, the overall PE for the S&P is 21 right now. The stocks are expensive. And then the person on the other side will immediately come back and say, oh, yes, but valuations are not a market timing tool. Valuations are never a timing tool. They're the worst. They're literally the worst timing tool that data can show us exists. So you cannot look at a PE ratio and not buy a stock for that reason. That's pretty much foul play. You just can't do that. What I would propose as a better thing to do would be to look at 3 things. Look at the PE, sure, but then look at 2 other things and then make your decision. Margins and year-over-year revenue growth. The year-over-year revenue growth and the margins actually decide where that PE is going to be. So for a company, and by the way, the forward PE of Cadence Design is somewhere between 39 and 41, depending on which analyst you believe. So that 39 to 41 as a forward PE for Cadence Design is higher than 21 as an average for S&P because of this 19% year-over-year revenue growth and its 40% margins. A lot of companies with lower PEs have margins around, I don't know, somewhere between 5 and 20%. A lot of companies with lower PEs have revenue growth, I don't know, around 5 to 10% or year over year. So you have to consider those things. You're paying for higher year over year revenue growth and you're paying for higher margins. So the PE is probably right where it should be for Cadence Design. It's not expensive. And even if it was, that's not a timing tool for when you decide to buy a stock. And I'll just finish by saying, you said the same thing about Axon, and now you've missed out on a huge move in Axon. We've gone from like 380 to 425 in the period of time since we recorded on that. I was bullish. I made that money. You were bearish because of valuation. You didn't make that money.
Yeah, I mean, things can turn just as quickly as they go up. Things go down. What goes up must come down. I mean, I disagree with you. I like to look for things that I think are undervalued, and then I go ahead and invest my money there. This is to me, CDNS is trading exactly what the market has valued it. I think it's already baked into the cake. Now, I'm not saying I'm a holder of CDNS. However, I'm not a buyer. So that's just my particular opinion. Sometimes that works out really well. Sometimes you maybe miss out on some gains, but I love Axon as a company. Love Axon as a company. Traded it multiple times. However, I do think the evaluation is still high, and I do think CDS and valuation is trading right where it should be. You cannot tell me that my price target for a company like Starbucks, for example, is 95. You can't tell me, oh, okay, yeah, I can look into buy Starbucks at 70, 60s. But if Starbucks is trading at 110, I'm a buyer of Starbucks. No, you have to look at the whole picture combined. But I do like what you're saying in regards to looking at revenue growth, looking at their EPS, looking at some of their financials over a long period of time. And the market does reward 19% revenue growth year after year.
So it just so happens I pulled up ChatGPT to show some data on this. Robert Shiller's data on PE ratios for the S&P 500 shows that there is literally no correlation between PE ratios and one-year returns. So in other words, it literally does not matter whatsoever the PE of your company. There is no correlation between PE ratios and returns on a one-year basis. None. So it just doesn't matter. I hate to say that, but there is some correlation for a 10-year hold. Now, I see you as someone who's usually not trying to hold stocks for 10 years, but over a 10-year period, if you get into the stock at a higher valuation, there is some correlation there. But for a one-year time period, there's no correlation between momentum is probably more significant of a factor to consider and things like revenue growth than it is just the sheer valuation. So statistically, you're not right on that one. But and I think it's kind of been shown out in some of the things that we've seen. But I'm also a big believer that the overall market, the overall economy, is a big decider of where your specific stock is going to go, more so than the P ratio or even factors related to the specific stock.
We're having a little debate here, but you're saying basically I look at PE and then decide on what to do. That's not it. I think you use PE as a part of a data set. You use technical analysis part of the data set. You use their macro trends as part of a data set. You look at the overall sector as part of the data set. And for example, sometimes when the chip sector is damaged, you may not be a buyer. I'd rather usually be a buyer when the momentum is with me, coupled with looking at their PE. So you don't just use PE only to try to trade stocks. I'm not arguing that. I'm saying currently, CDNS, in my opinion, is trading for about what it's worth. It's trading at my price target for the year. I'm not a buyer. I'm a holder. I'm not necessarily a seller. Okay, I'm a hold. But I can't say that I'm bullish on this stock right now. I'm not bullish.
And all I'm saying is you should use factors that matter more than PE to make that decision of whether or not you're bullish. So revenue growth year over year and margins make that decision for you, not its valuation, not whether it's at the price target that you have right now or not.
And you can look at growth all you want, but we've seen a company like SMCI, who we both have talked about multiple times on this podcast, now trading at a PE of 5. So, there's a lot of other factors.
I'm glad you brought this example up because this example proves you completely wrong. So you look at SMCI, it's at a PE of 5, so it would be a great buy based on your take on things, but it's not a great buy because the reason it came down from the PE of whatever it was at sky high down to where it is now is because of fraud, not because its PE was high.
You argued in this last podcast, listeners, you can go back and listen. James said, look at the PE, look at the PE. This is a buy. And I said, you may not want to touch this stock right now. It may break through this support level. And if it does, there's nowhere else it can go but to the bottom. So I said that. You said, oh my gosh, look at this P. I am a buyer. And I said, I am not a buyer. Now, SMCI sold a good product, and SMCI's price target, you and I both agreed on based on their revenue growth and the way they were growing. However, in this instance, you're going to eat your words because you said, James said, I am a buyer at this current P. So you can't take the bull and whip to me when I'm just saying, oh, you need to look at the whole picture. So that we can both agree on. You look at the whole picture. You can use PE as part of the data. my argument to circle all the way back with CDNS is you have to explain to me why I am a buyer of CDNS and not Synopsys, or why would I not choose Synopsys when I think Synopsys is a little more undervalued compared to what the market is priced in. CDNS, it's already baked into the cake.
So actually, I did make money off of SMCI, by the way. I bought it in the high 300s and I sold it in the high 400s. Or actually, the last bit of it that I sold was after it dropped for this latest bit of news. So I did do a trade from the high 300s to the high 400s, or I believe it's now, due to their stock split, it's now high 30s to high 40s. So there actually was a good trade there. And actually, the valuation had dropped too much. And actually, a lot of people made money going from the 30s to the 40s on SMCI. That's a huge move from 38 to 49, which is where it topped out. That's a huge move, and people could have made money and did make money, including me, off of that. Now, if you look at it for a 10-year trade, so I was also once again right. If the company isn't going to get delisted from the NASDAQ or go bankrupt, then it actually, based on what I just said from the 10-year data on valuations, it actually is a good buy based on a PE ratio of 5. Now, that being said, all of these things don't matter for that specific company, because that specific company is only in trouble because of fraud, accounting mismanagement, things like that. It's not because of their PE ratio. It's not because of their year-over-year revenue growth, and it's not because of their margins. None of that has anything to do with where the stock is going. It's only an issue of accounting, fraud, and things like that. So really, SMCI doesn't apply to the argument we're making right now. But for Synopsys, you really need to know, like, what's the year-over-year revenue growth, and then what are the margins? So tell me those two things right now, Kai. What are the margins what are the operating GAAP and non-GAAP margins for Synopsys, and what's the year-over-year revenue growth for their last quarter's earnings? If you can tell me that right now, then you are right about your thesis on Synopsys being a better buy than Cadence. If you can't tell me those things right now, then you just don't know what you're talking about. So can you tell me those things right now?
Oh, I'm guessing their margins are around 50%.
No. We're not guessing. We're not guessing. You have to know for you to say that Synopsys is a better buy than Cadence. What are the margins? What's your year-over-year revenue growth? You don't know. You don't know. So don't tell me that Synopsys is a better buy if you don't know those things. My point is, all you're looking at is PE, and you're wrong for that. So you have to actually know those things, because those things decide the PE.
Yeah, I'm going to disagree with you on when you make a decision on when to buy and when to sell, and everybody has a little different way to go about this. You sat on this podcast and you said, I'm a buyer based on the PE it's trading at and at the product that it's selling of SMCI. And you just literally said a few minutes ago, momentum matters a lot more. So,
and it had the recovery momentum from 30s to 40s. It had a pretty impressive, like 25% move from 30s to 40s.
I would say, I just wouldn't do it. I wouldn't do it, but
it's a trading vehicle. Airline stocks are the same. SMCI is a trading vehicle. Airline stocks are a trading vehicle. Boeing is a trading vehicle. And DJT is a trading vehicle. And just to bring it back to the point on momentum, DJT, as you know, I got in around 14 and it went all the way up to 53, and I closed trades at 53. You never touched it. You missed all of that move. So that's not a PE issue. That's not a valuation. We know that DJT has no value whatsoever. These are different types of classifications. We look at some stocks based on their revenue growth and their margins. We look at other stocks just based on momentum. And then some stocks like SMCI, we just look at based on the fact that they've got some fraudsters running it and you want to stay clear. You're right, for a 10-year, you want to stay clear. But every stock, every sector is a different sector and a different stock. You have to look at them all independently. Anyways, going back to the issue that you talked about earlier on, well, I guess I'll give my wrap up on CDNS. And then I want to just touch really quick before we stop on the issue of the election, because it is going to affect stocks. We don't have to get political, but you mentioned a few things on that. And I think we should probably just touch it real quick because we're 2 days before the election right now. So I am buying Cadence Design Systems for their 19% year-over-year revenue growth and their margins in the 30 to 40% range, and because they are the dominating power in analog chip design. So we've got our election coming up in 2 days here. I think that regardless of who wins, we're going to grow the deficit quite a bit. That's probably the one thing that everyone agrees on. What there is some disagreement on is one thing that you told me about, which is the issue of tariffs. So Trump is favored to win in prediction markets in some of the polls, I agree with you that if Trump wins, that he won't put on as many tariffs as he says he will. So apparently he's come out with a blanket statement about tariffs, putting on lots of tariffs, blanket tariffs. And every economist in the world knows that tariffs are actually a tax on the population. So just to be clear, for anyone who doesn't know this out there, this is the way that tariffs work. You put a tariff on a company abroad bringing their goods to the US, the company raises their prices, and then the consumers and the company receiving the good wind up paying that price increase. So in other words, the consumer pays more, the government gets that money. Okay, so the government of the country you're in gets the money because they put a tariff, and the company doesn't pay any money because the consumer winds up paying it. So it's the same thing as a tax. Every economist in the world knows that. So there is some concern with Trump coming in. If he puts on pretty big tariffs, we could have higher inflation long term. And I explained this to you on the phone the other day. We could wind up with a 10-year rate that's a lot higher, making it harder for people to buy homes in addition to other trickle-down effects from that. So you think that if Trump wins, and you can see I'm talking more about if Trump wins rather than if Kamala wins, because he is favored in a lot of prediction markets for this and in state-by-state basis for swing states. So you think if Trump wins, you think that he will not put on blanket tariffs, is what you're saying.
Yeah. So are we getting into a conversation about tariffs? I think what you said is highly inaccurate. So no, I disagree with that, but I'm not going to get into that right here and right now. I think there's a few things with Trump or just in general that I look at in that Trump is more pro crypto. And so that particular was something that matters to me. I also think just historically, when you look over the last 100 years, when a Republican's in the White House, the stock market it has better returns. When a Democrat's in the White House, the stock market doesn't. In the realm of around 15% for the year versus 7% for the year. So I'm not going to say on here, which way. That's in general. We talk about AI, and I think Trump is going to be better for a lot of companies in regards to AI. I also think from crypto, Trump's going to be more of a supporter there, and I also think that just based on the data, when a Republican's in the White House, 15% returns per year for the S&P versus 7% Democrats. That is not pro-Republican. I'm not a statement that is not. That is just straight up just part of the facts. I'm not going to go into what I think about tariffs or, for example, what you said about tariffs, and that's a tax on the average American. I absolutely disagree in regards to what you said there, though. For example, let's just look at cars. You put a tariff on Japanese manufactured cars. That does not mean that Ford cars go up in value. Cars that are made by Ford. That means that basically Toyota goes up in value. An American consumer has to pay more for Toyota than they would a Ford F-150. That's what that means. This is not a blanket statement, tariffs just caused this. So I think that there's a little bit of sort of a political statement in what you said. I can't say that, oh my gosh, every economist is going to agree. Trump did tariffs when he was in office the last time, and we saw inflation the lowest it had been, the stock market the highest it had ever been prior to when COVID happened. So I don't want to sit here and get into an economic debate about tariffs because it's an AI show. I just know, just based on the data and what I'm trying to decide for the future, stock market returns. The P to E ratio of the S&P 500 is very high right now. Prices for stocks are very high right now. We're talking 40% return for the S&P 500. That's quite a bit. I was reading something on Yahoo Finance, et cetera, that there are some economists that expect 1% from the S&P return in the coming years. 1%. So, 40% is a lot this year. It's been a great year. But at some point, we'll have to see the way things go. So I'm positioning myself accordingly.
Well, yeah, we can go ahead and close out, but just a few things I'll say in response to that. So you're actually wrong about the Ford thing. If prices of imported goods go up due to tariffs, 45% of the parts that go into a Ford car come from abroad. So unfortunately, the Ford actually does go up in price if we put if we put tariffs on imports. And so like I said, 100% of economists, anybody who's even studied basic economics knows that tariffs are essentially the same thing as a tax. There's no net benefit for the consumer. The prices of everything goes up, and the government makes essentially that money because businesses just raise prices. So it's essentially another tax. But I don't think that Trump is going to put those tariffs on. I also agree with you. I think that Trump is going to be good for the stock market, and mostly in the sense of deregulation. We have to allow mergers and acquisitions in this country. I listen to people like Jim Cramer just mock the things that the DOJ is doing. They literally sued Capri from a merger on handbags, luxury handbags. They're stopping companies that make luxury handbags from merging, saying that it's helping the consumer. Absolutely ridiculous. We have to have regulatory relief in this country. That is not a political statement, it's a business statement. And we have to have that. So we need Trump for business to flourish in this country, and that will have a trickle-down effect to stocks. I'm not, as you know, Kai, I shook Barack Obama's hand twice. I've been a liberal in the past, but when I look at what the government has done to crypto and also to mergers and acquisitions in our country, it's sad. I mean, companies can't even IPO. We need regulatory relief drastically. And I also am interested in what Elon might do with his Department of Government Efficiency for making the government more efficient. So I'm really interested in those things. Just to close out, I wanted to tie one last loose end here. So Synopsys on their last quarter had a 13% year-over-year revenue growth, and their margins are 35%. So, but their margins and their year-over-year revenue growth are significantly lower than Cadence Design Systems. So 13% revenue growth versus the 19% of Cadence Design, and the 35% margins non-GAAP versus 40%. So you get what you pay for. You get what you pay for in a lot of things in life. I'll go ahead and close out there. So thank you for watching our show. We will be back on the next episode to talk about more AI stocks. Thank you so much, Kai.
Thanks, James.
The first revolution is when you change your mind about how you look at things and see that there might be another way to look at it that you have not been shown. You will not be able to stay home. You will not be able to plug in, turn on, and pop out. The revolution will not be televised, and be no rerun, brothers and sisters. The revolution will be live.